Hello and welcome to Flagstaff TV. Today we are joined by David Mirzai, who is an energy analyst at SP Angel. David, thank you so much for joining us today.
Hi, Catherine, and thanks for having me on again.
Now, Angus Energy reported their interim results last week. What were the key takeaways for investors?
Yeah, so for those of your investors who are unaware of Angus Energy, the company's it's an onshore UK focused EP with about 1,500 barrels a day of oil equivalent production that mainly comes from the Saltfleetby gas field in Lincolnshire. Last week, the company reported solid Saltfleetby gas volumes for the 6 months to the end of March, and that generated about £7 million worth of EBITDA, and that reflected about 90% operational efficiency on the field during that period, which is pretty high and much higher than historical levels. So all in all, quite a good kind of interim period for the company in terms of their results.
The company also completed a refinancing during the period. How has that affected the balance sheet?
Well, in short, that refinancing has provided significant relief from a legacy debt issue. The key event during the report period was the successful restructuring of Angus's debt. They brought in a £20 million debt facility from Trafigura to replace their existing debts. That debt had been built up by the previous management team in bringing the development of Saltfleetby on stream. And as a result of both the interest relief on the debt, but also hedging that had been put in place to kind of guarantee that debt, the company's cash flows were being significantly impacted by those debt facilities, by those hedging contracts. Now, one of the first tasks of the new management team when it came on board last year was to try to refinance those debt facilities and try to fix those previous issues with the balance sheet. They were able to get the Trafigura facility on street, agreed in March this year, and that provided a new set of debt facilities at a far lower interest rate, far less onerous terms, but also provided some working capital for the company to go out and do some short-term impact projects on their asset base, which could grow production and cash flow further. On top of that, the previous hedge contract, and that was replaced with a gas offtake agreement with Trafigura. And what you'll find is over the next 12 months to the end of June 2025, you'll find those effective hedges rolling off the balance sheet, such that 12 months from today, the company will be completely unhedged. And therefore, any kind of gas they sell going forwards from that point, that they'll receive the full benefit of the market price.
Now, the company recently added a second producing asset. How is that contributing to the portfolio?
Yep, so Angus announced a workover of the Brockham 2Y well. That was in May. They successfully reinstated production from the field. What they had to do is they had to replace some tubing. They had to put in a new pump. I think that well had been shut in a couple of years ago. So it was just a case of having the capital in place to go in and rehabilitate the well rather than having to do any fancy operations. The company said that currently that well's come on. It's in excess of management expectations. It's producing in and around 40 or 50 barrels of oil per day. And it's expected to be in and around that level going forwards. And you've got potential to increase that level of 40, 50 barrels of oil with further operational improvements. Now, it's not a huge money driver for the company, but what it means is that asset, which was previously cash flow negative because you have to maintain it, is now slightly cash flow positive. So as well as providing a certain amount of funds, it also stops some of the drain from that asset on the balance sheet. This for us is evidence of the board's plans to maximise the potential from the existing portfolio just by putting small amounts of capital to work and receiving quick payback on their investments. In addition, also as their second field on stream, it complements production from the existing Saltfleetby gas field.
David, what can investors in Angus look forward to in the near term?
Well, I think for Angus itself, the management there, that most of their operational focus, most of their existing activity will be on increasing production at Salt Fleetby. We learned that production is probably in and around 7,500 million scuffs per day, and that's just over 1,200 barrels of oil equivalent from the field. And you've got capacity to take that production up to towards 9 or 10 million cubic feet per day, with additions to the well stock, with additions to the equipment. The first thing we'll see is a new compressor coming in before the end of the year. That compressor will allow you to increase the gas production probably up to around 7.5-8 million scuffs per day, and then further work on the field, including the potential for additional wells or workovers of existing well stock, both next year and 2026, should further increase those production numbers. Separately, the company or the new management, should I say, has kind of made no secret of its ambition to proceed with a strategy of acquisitions, which they think will add to overall production units, so overall production volumes. It will reduce the unit cost in terms of G&A and stuff, but it will also act to decrease the risk in the portfolio by spreading production over a greater number of fields and wells. Management said recently that they've identified 3 geographic regions of interests that they're pursuing. We expect them all to be OECD existing production assets. We're not expecting them to go off and have a complete change in strategy and for example, go exploring in West Africa offshore or anything like that. But what we do have to do is we have to wait for the management to tell us what they're going to do, probably in the second half of this year.
David, finally for today, how could the UK elections this week impact Angus Energy and also the wider UK oil and gas industry?
Yeah, so the UK oil and gas operators, the domestic listed ones, have had a tough 6 months. If your investors remember, back in January, February, the Labour Party came out and said that once they came into power, what they were intending to do was to increase the tax rate by 3% to 78% corporation tax rate, which is in line with Norway's licensing regime. But they also alluded to making potential oil and gas fiscal changes regarding capital allowances, which has been very negatively received by the market. That in itself has created a period of volatility for the UK fiscal and licensing regime, which has had a knock-on effect as it's pretty much dried up activity, capital investment activity for UK oil and gas producers. Clearly, no one wants to invest money if they don't know what the tax regime is going to be like in 3 to 6 months. Now, we'd like to hope that the Labour government, as with a lot of its policies, is going to have a more pragmatic approach to the oil and gas industry. It will recognise that the country will need oil and gas for the next 20 or 30 years. It will see the benefits both in terms of lower emissions from those domestic oil and gas producers as opposed to international producers, but also the contribution that the UK oil and gas industry makes to things like tax revenues and job creation and well-paying jobs in specific areas of the UK. And we will hope that if successful on the July 4th general election, that Labour, as I say, kind of rolls back some of that risk, which is currently in the market, and leaves the oil and gas sector intact, to return to investment once they're sure that they're not going to be overly penalised by changes in the fiscal system. Nonetheless, whatever happens from an oil and gas sector basis, the UK oil and gas sector will go on. It will be companies such as Angus that have existing cash flow, existing operations, which will be most apt, most well positioned to consolidate the sector past any changes in the fiscal regime. And as management have told you themselves, Angus Energy are not alone in looking outside the UK for additional portfolio interests, which might complement its existing UK base.
David, thank you very much for your time today.
My pleasure.
And thank you for watching Flagstaff TV.